Good morning, dear students. So today we have our discussion on two standards, that is your queries and some problems. So that is dealing with Ind AS 12 on income taxes, as well as Ind AS 19, that is employee benefits. Okay, so let us begin. Both these standards are pretty important from your examination perspective also, and from a more practical perspective also. Both these standards have their own importance. So let me run you through the basics of Ind AS 19 in brief. I hope you have already viewed the sessions that have been presented to you. So based on that, let us commence our discussions on the standards. So now coming to Ind AS 19, just a second. All right. So what Ind AS 19 deals with? It deals with employee benefits. So when we talk about employee benefits, it covers broadly four categories. One is your short-term employee benefits in the form of salaries, in the form of short-term bonuses. So all these put together form part of your short-term employee benefits. Then you have your post-employment benefits. Apart from post-employment benefits, you have other long-term employment benefits and termination benefits. So when we talk about post-employment benefits, it essentially covers items like your gratuity, for which a payout will happen after you complete your employment. So that is the major one which we are going to discuss. So under the post-employment benefits, you are having two plans which are broadly categorized into defined contribution plan as well as defined benefit plans. When we talk about defined benefit plans, that is the major one from your examination perspective. Then you have other long-term employment benefits, like for example, an employee completes say 10 years of service, 15 years of service. He still continues to work, but he has not retired, neither is he retrenched, but the company feels because he has served for a long time, we have to give some more benefits to him. And therefore, there is something known as a long-term service award, which is given. So typically these get covered under that. And finally, you have something known as termination benefits. So when we talk about termination benefits, this basically covers those items which are under the broad category of retrenchment compensations. So when we talk about retrenchment compensations, it means an employee is forced to leave the company for which the entity pays certain contribution, for which the entity pays certain amount to the employee. So that is your termination benefits. And after that, we have certain uh, appendices A and appendix A and appendix B that form a part of this standard. So these are the three broad categories that we are having as far as our discussions are concerned. Is it okay till now? Yeah. If you have any doubts, please feel free to ask in between. Okay. Just a second. Okay. All right, fine. Now, so when we talk about employee benefits, the main reason why this standard was introduced is first one is in the P&L, this is a very critical expense head that is there. It forms a major portion of your expenses, particularly in the services segment. Your employee cost is the major one. And in your manufacturing sector also, apart from material cost, it is employee benefit, which is the next key item of expense in the financial statements. So therefore, they needed some kind of clarity that was required on this standard. We had a corresponding standard AS15 that dealt with this under the accounting standard regime, but now it's in AS 19. So now, why do I need a separate standard on employee benefits? Because the whole point is we need to have uh, a matching way of recording my expenses. An employee comes to the organization, performs services, and he gives benefits to the entity. And to match those benefits, we need to account for that cost. So the basic criteria behind this standard is, or the basic principle behind this standard is that you are having a matching principle. I have to match my cost against the benefits that the employee is giving by way of his employment. So this is the whole principle behind this standard. So when you talk about employee benefit expenses, we have seen what all is covered. So everything is covered except employee share-based payments. Employee share-based payments are not covered because you have a separate standard under that Ind AS 102, which deals with employees share-based payments. And you are not going to discuss accounting and reporting by the employee benefit plans. So what is an employee benefit plans? We will come to that shortly, but these two are not there. These two are not there. So when you talk about an employee, it means full-time, part-time, permanent, casual, as well as the temporary basis workforce. All of these are together forming part of your employees, and it also includes directors as well as other managerial personnel. When you talk about employee benefits, it not only restricts the benefits payable to the employees, but it also includes those benefits which are payable to their spouses, children, or other dependents, or to their legal heirs or nominees, or to others such as trusts or insurance companies. So it is covering a very wide gamut of payouts. It is not restricted. It is not particularly restricted to payments directly going to the employee, but also to his or her family. And as I discussed at the start of this session, we broadly categorize it into short-term benefits, post-employment, other long-term benefits, and termination benefits. So these are the four heads which we are going to discuss. Coming next, what do you mean by short-term benefits? Benefits which are due to be paid within 12 months from the end of the period in which the employee has rendered the service. So within 12 months. So these include typically your salaries, wages, and your social security contributions, paid annual leave, paid sick leave, profit sharing and bonuses, as well as your non-monetary benefits. So these are the items which we are going to pay out typically. This is an illustrative list. Since it is going to be paid within 12 months, there is no need of any form of discounting. You just do a straightforward accounting, employee expense account debit, employee benefit expense account debit, to liability or to cash. So this is the typical journal entry that you are going to pass. Of course, if you are constructing an asset out of this, you are going to capitalize the employee benefit expense since it is directly relatable to the cost of the asset. Actuarial assumptions we are going to see, but they are not specifically required in view of the short-term payout that is there. No other specific disclosure under Ind AS 19, measured on an undiscounted basis at nominal value of the cash flow. You cannot have an actuarial gain or loss in this particular case. Change in timing of settlement. If the entity's expectations is temporary, then reclassification not needed. Suppose you are some benefits you are delaying beyond 1 year for a very temporary period. Like for example, a new employee joins and you give a retention bonus, which typically would be paid within 6 months or 8 months. But you say that I will extend it to 12 months, and this is beyond 12 months, say 14 months, I will pay this out. But this is only one time. So if that is the case, you can continue to regard it as a short-term benefit. There is no need for you to do a reclassification. However, if you are expecting that the change is not temporary, the characteristics of the payout itself change, then you have to ask the question whether it is a short term benefit, or will it come out of short term benefit and go into post employment or other long term employee benefits. Is it okay? Yes. So in this, we have short-term compensated absences. Short-term compensated absences, the next one, you have, this is a slightly important one. Basically, this is the paid leave that you are having. This is the paid leave that you are having. So these are broadly categorized into accumulating and non-accumulating paid absences. So when you talk about non-accumulating paid absences, this means you cannot carry forward. This is typically items, leaves like casual leaves. You don't get a carry forward benefit of this. So they cannot be carried forward. They lapse if the current period's entitlement is not used in full. Obligation arises when you are having obligation arises when absences occur because employee service does not increase the amount of benefit. Means what? Whether the employee comes or whether the employee avails the leave, your payout is going to be the same. Your payout is going to be the same because these benefits, these leaves cannot be carried forward to the next period. And that is the reason you are typically having these expenses recognized when absences occur. That means when employee does not come, you continue to recognize the payout in the form of basic, whatever is the salary that you are paying to that employee. Okay, so this is not so important, but the next one, accumulating paid absences, this is the one that is important for us to understand. So when you talk about accumulating paid absences, these can be carried forward for use in the future period. Okay, so this is typically privilege leave, or some special leaves where you are allowed a carry forward to the next year for settlement. Obligation will arise as employees render service that increases their entitlement to future paid absences. So if an employee renders a service, that service leads to leaves, and that leaves will give rise to future paid services. So that is the reason you are going to recognize these expenses based on the services that they render. So these are further classified into vesting and non-vesting. Vesting means what? Against the leaves that you have, you are able to exchange it for cash. You are able to exchange it for cash. And non-vesting means what? You cannot exchange it for cash, but instead you can avail what you can do. Employees are not entitled to a cash payment for unused entitlement on leaving the entity. Instead, you are going to get a further leave for the future periods. You are going to get further leave for the future periods. Are we okay with this? Yes. Any doubt so far? Anybody on the Zoom? Any doubts? Any queries? Manish Kumar Gupta? Yes. Any queries? Please respond. Yes. Any doubts? No doubts. Yes. All right. Okay, fine. So let us proceed further. We will just quickly look at one or two questions, how this is particularly done, so that we can understand the logic that is there. So Mr. Rajan is working for Infotech Limited. Consider the following particulars. Annual salary 30 lakhs, working days 300. This is a very simple example basically to explain how the accounting happens. Okay, in real situations you don't have such kind of workings. This is just to make you familiar with the reasoning behind putting these particular what you can say, these particular provisions. Okay, leaves allowed as per the company policy 10 days. Leaves utilized is 8 days. That means still 2 days are unutilized. The unutilized leaves are settled by way of payment. So what is the category? Is it non-accumulating? Is it accumulating? In accumulating, is it vesting accumulated absences, or is it non-vesting accumulated absences? Come on, tell me. What is the nature of this unutilized leaves against which a cash payout is happening? Tell me. Carry forward of such leaves to the subsequent period is not allowed. So come on, tell me. What is your nature of employee benefit in this particular case? Non-accumulating. Are you sure? Is it non-accumulating? Non-accumulating cannot be carried forward. Cannot be carried forward. But if you look at accumulating, you can either carry it forward. Obligation arises as employees render the service. They are entitled to a cash payment. So these are vesting benefits. These are vesting benefits. आपको लीव के सामने कैश मिलेगा. आपको लीव आपने यूज नहीं किया है, उसके बदले में आपको मिलेगा cash. Okay, instead of in place of that leave, you are going to get cash. So very simple working. 30 lakhs for 300 days. So that comes to 10,000 per day. That comes to 10,000 per day. Against 10,000 per day, he has not come for 8 days out of 10 days allowed. 2 days he has come. These 2 days he cannot carry it forward, but instead he can provide the service. So he has provided the service by coming for those 2 days. And because he has come for those 2 days and rendered the service, you have to make the payout. So for 2 दिन आया, he came for 2 days. He provided services. Those services gave benefits to the employer. Because the employer got benefit by virtue of him coming for those 2 days, we have to recognize the cost of those 2 days. So those 2 days cost will be 10,000 into 2, that is 20,000 rupees. So the total benefits that we are going to pay is 30 lakh his annual payout plus 20,000 rupees. 30 lakhs plus 20,000 rupees. Okay, fairly simple. All right. So you are recognizing based on services rendered. He came for 2 days. He could actually have taken leave, but he did not. He came for 2 days. Against those 2 days, he got what? He rendered services. So because he rendered services, I will recognize my employee benefit expenses based on services which are rendered. Are we okay with this? Yes, are we okay? So total expenses 30 lakhs plus 2 days unutilized leave. So that is 30 lakh 20,000. Any doubt so far? Okay, any doubts? All right, let us move on to the next one. This is discussed. All right, so now coming to the similar discussion. Mr. Niranjan working for Infotech Limited, consider the following particulars. Annual salary for the first year is 30 lakhs, number of working days 300, leaves allowed 10 days, leaves taken 7, and carry forward leave is 3 days. Based on past experience, Infotech assumes that Mr. Niranjan will avail unutilized leaves of 3 days of the first year in the second year. Infotech contends it will record 30 lakhs as employee benefits in each of the years 1 and 2, stating that leaves in any case will be utilized by the end of the second year. Comment on the accounting treatment proposed to be followed by Infotech and past journal entries for both the years. Okay, tell me one thing. What is the nature of this short-term absences? Is it non-accumulating? Is it accumulating? If it is accumulating, is it vesting accumulating absences, or is it non-vesting accumulated absences? What is the nature of this? Oh, somebody is chatting on the Zoom also. Yeah, that's right. That's right, Abrakesh. Manish, क्या लगता है बेटा? What is it? Is it accumulating? Is it non-accumulating? If it is accumulating, is it accumulating paid? I mean, vesting or non-vesting? That's right. That's right. It is accumulating non-vesting because against a leave, you are not getting cash. You are able to carry it forward to the subsequent period. All right. Now, what he has done is he has availed 7 days leave in the first year. Okay. अभी 7 days leave तो ले लिया. That means 3 days he has not utilized, so it gets carried forward. So next year, he is able to take a leave of 13 days. He is able to take a leave of 13 days. Now, see, total working days 300. First year 7 दिन वो आया नहीं. He did not come for 7 days. That means he came for only 293 days. That means he came only for 293 days. Yes. Now, second year, 300 working days. He did not come for 13 days. He did not come for 13 days. That means he came for 287 days. Yes or no? That means he came for 287 days. What the company is saying is, I will book expense of 30 lakhs in year one. This is year two. I will book expense of 30 lakhs in year two. You tell me, is this logical? Is this logical? Yes, year one, he comes for 293 days, expense booked is 30 lakhs. Year two, he comes for 287 days, expense booked is 30 lakhs. Is this logical, or is there something which you find an aberration? Is there something that you find as an aberration, as something inconsistent? क्यों गलत है मनीष? Yes, Abrakesh, is this correct? What the company is asking, or is something not right? Yes. Okay. It is not right. Very simple. He has come for 293 days in the first year. You are booking 30 lakhs. In the second year, he has come only for 287 days, and again you are booking 30 lakhs. That means in year one, the days present is 6 days. He has served more as compared to year two. So cost also should be booked more. Yes or no? By cost zyada book hona chahiye in the first year. And in the second year, less cost should be booked. Payouts can be the same. Payouts can be the same. But the expense that should be booked, remember the underlying principle. I will recognize the expense. I will recognize the expense based on what? Based on the services that are rendered. He has rendered more service in year one, and therefore we should book more cost in year one. He has rendered less service in year two, and therefore reduced cost should be booked in year two. So how do we do it? In this case, it is very simple. See, per day salary is 10,000. Per day salary is 10,000. 30 lakhs divided by 300 days. Divided by 300 days. That means in year one, he came to office. He had 10 days facility of utilizing the leave. but he has utilized only 7 days. So 3 days he has not utilized. You expect him to utilize it in the future. You expect him to utilize it in the future. So what are you going to do? He has worked for 3 extra days. So for the 3 extra days that he has worked, I will recognize an expense. I will recognize an expense of 30 lakh divided by 300 into 3 days. So that is 30,000 rupees. So therefore, total expense to be booked is 30 lakh 30,000. But sir, 30 lakh 30,000 to you booked, but you will pay only 30 lakhs. Now, this is not a cash benefit that you are going to give for the extra work that he has done. This is not a vesting benefit. This is a non-vesting benefit. So cash you will not give. Huh? So who is giving the cash? Nobody is giving the cash. Yes. So what I am going to do is I will pass the entry like this. Employee benefit expense account debit 30 lakhs 30,000 to bank 30 lakhs to provision for short-term absences 30,000 to provision for short-term absences 30,000. All right. Now, in the next year, what will happen? He availed the 10 days full quota. He has availed the 10 days leave full quota. And he did not come for additional 3 days. जो year one balance था, the balance of year one in terms of leaves, he utilized that in year two. So he did not come for 3 days. And because he did not come for 3 days, my expense should be reduced by that amount. So it will come to 29 lakh 70,000. Sir, if that is the case, payout will happen of 30 lakhs only, na? Yes, payout will happen of 30 lakhs. So at that point of time, the entry that you are going to pass is, you will reverse this provision. He has utilized the leave, so that provision gets utilized. Provision for short-term absence is debit. So this will be 29 lakh 70, 30,000 to bank. 30 lakhs. Are we okay with this? Yes. Are we okay with this? Anybody has any doubt so far? Yes. No doubts. Okay. Manish, समझ में आ गया? Yes, all clear. Okay, perfect. So that takes care of the understanding part. Okay, now, so this question is done for you. Okay, illustration 2. Sorry. This is illustration 3. Now, sir, this question was simple because you were given year 1, year 2 data. In real life, when you are closing the books of year 1, are you aware about year 2? In practical life, when you are closing the books of year 1, are you aware of year 2? Tell me. When you are closing year 1, are you aware what happens in year 2? Yahan pe to this is academic. So year 1 also is given, year 2 also is given. So are you aware about the second year? जब आप year 1 का data करोगे, you will only be aware of the leave that will be carried forward. You will only have one data which you are going to know. That is the 3 days carried forward. Only this you will be aware. How much he will utilize in year 2? आपको मालूम है? नहीं, I don't know. Can he utilize 1 day? Yes. Can he utilize 2 days? Yes. Can he utilize 3 days? Yes. Can he utilize nothing and say, I don't need any leave because I have to work extra, my workload has increased? Can he say that? Yes. So he has 4 options with him. He can utilize nothing. He can utilize 1 day, 2 days, 3 days, in addition to the 10 days quota that is there of the second year. Yes or no? Now, if that be the case, how do I do the accounting? Suppose I estimate he will utilize 3 days, but he has utilized only 1 day. I estimate that he will utilize only 2 days, but he utilizes all the 3 days. I estimate he will utilize nothing, but he still utilizes all the 3 days. Are you able to understand the various permutations and combinations which are possible? Yes. So when such kind of a scenario is there, this works on the basis of estimate. This works on the basis of estimate. वो employee का देखो, what is his leave taking patterns? What are his leave taking patterns? And based on that pattern, you make an estimate. Okay, I have seen last 5 years carry forward leave, whatever is there, he avails it entirely in the next year. He avails it entirely in the next year. So if that is the case, take 3 days as the leave and recognize the cost of 3 days in the current year. Next year, whatever he takes, you utilize that, balance you write off by treating it as a change in accounting estimate. By treating it as what? By treating it as a change in accounting estimate. Yes. So on similar lines, you have further question. Infotech assumes that he will avail unutilized leave of 2 days only, but he has taken 3 days in the subsequent year. Is he permitted to take 3 days? Answer is yes. Nobody can stop it. So why did you estimate 2 days? It is an estimate. It is an estimate, right? You cannot say why. I have data to back up my estimate. So I estimate he would take 2. He has taken 3. We have to book the expense of that additional 1 day in which year? We have to book it in year 2 because you came to know about that only in year 2. You came to know about that only in year 2. So how does the accounting happen for this? How does the accounting happen for this? Well, first year, I will book an expense of 30 lakh 20,000. 30 lakhs base value. He came for 2 extra days, is what I assume. He came for 3 extra days, but he will avail a leave of only 2 days in the future. So I will book an expense and record a provision for leave encashment in the future of only 2 days. So 2 into 10,000, that is 20,000. 2 into 10,000, that is 20,000. Are we okay with this? Yes. Are we okay with this? Anybody has any doubts? First year, is it clear? First year, is it clear? Yes. First year, is it clear? Bolo. Then we will come to second year. Yes. All right. So that takes care of this. Okay. No doubts, I presume. Coming to the next year. Coming to the next year. Now, what this fellow did, instead of 2 days, what you estimated, he has taken full 3 days. He has taken full 3 days. So let us understand. He came for 287 days. He came for 287 days. So he did not come for 3 days. He did not come for 3 days extra. So 30 lakh minus 30,000 employee benefit expense debit will be 29 lakh 70,000. Same like the last time. Okay. Payment, how much you will make? Sir, payment I will make 30 lakhs. Payment I will make 30 lakhs. Yes. Sir, difference, that is that provision for short term. Sir, but that is only 20,000. That is only 20,000. Provision for short term absences. 20,000. Is it matching? Answer is no. There is still a gap of 10,000. There is still a gap of 10,000. What do you do with this 10,000? Sir, what is this 10,000? This 10,000 is that 1 day extra leave that he has taken. That 1 extra day leave that he has taken in the last year. He had a carry forward of 3. I as management estimated 2, but he has actually taken 3 now. So therefore, what am I going to do? Well, I'm going to book this as an expense in the current year. I'm going to book this as an expense in the current year. So my employee benefit expense in the current year will be 29 lakh 80,000 and not 29 lakh 70,000. Are we okay with this? Yes. Are we okay with this? Yes. So how did I get 29 lakh 80? 30 lakhs minus 10,000 into 3. So 29 lakh 70 plus 10,000 additional expense due to change in accounting estimate. बस यही होता है leave encashment. Now, can you understand and appreciate that companies can play around with the profits here? Companies have a potential to play around with the profits here. Yes or no? Yeah. Yes. If a company wants to show profit, what it will say? All employees jinka carry forward leave is there. We estimate they will not utilize it in the next year. We estimate they will not utilize it in the next year. So in all the cases, that provision which you have to create, will you create? Answer is no. Because you are not created the provision, your profits will automatically become high. And therefore, this is a fantastic example of managing the profitability using such tactics. So as auditors, what we have to do is we will have to question the estimate. We will have to question the estimates that are there. Okay. So I have a question. What difference it makes whether leave availed pattern? Abrakesh, I did not understand your query. Okay. Just help me understand. Okay. All right. So coming next. So this takes care of it. Okay. So illustration 4, just go through it for homework. One second. Yeah, Abrakesh, tell me.
Good morning, sir. Sir, my question is that what difference it makes when we book whether the based on the pattern, whether it's a 3 leave or 2 leave in the subsequent years. Is it not a leave for the particular year, that is in our case year 1? So why should
See,
we bifurcate between 2 and 1?
See, the whole point, Abrakesh, is that in the first year, he has availed 3 leaves. So what you are saying is, I will not look at any pattern. I will always estimate that he will utilize entire 3 days in the subsequent period. That is what you are saying. Am I right?
Yeah, yes.
Previous patterns, let us forget, let us not even look at that. But what we are going to be concerned is, let us take the worst case scenario. He will avail all the leaves in the subsequent period. So I will make a provision for the entire amount.
Yes.
Correct.
Yes.
So that is one way of looking at it. But you have to understand one thing. See, we have come from an ICAI background. Yes, in CA intermediate, in your 11th, 12th standard, when you
Yes.
came, foundation, when you came, we have come from an ICAI background. What ICAI tells us, always be prepared for the worst and show the books. Show in the books also, you show the worst case possibility. That means be ultra conservative.
Yes.
Conservative is good, but being ultra conservative is what we have been trained in.
Okay. Okay.
Why do I say ultra conservative? Let me give you 2, 3 cases. You must have studied revenue standard Ind AS 115. In Ind AS 115, there is something known as variable consideration. In variable consideration, if there is an incentive component which is there, which is within the entity's control, what would you do in ICAP? Sir, any incentive I will recognize only when I'm actually confident of getting that incentive. Until then, I will defer it. Say you have a long-term contract. If you complete within 3 years, you get 5 crore bonus. So what AS9 used to do, or construction contract accounting used to do, is they would recognize that 5 crore bonus only if the job is actually completed within 3 years. But what Ind AS 115 tells us, Ind AS 115 tells us, be realistic. If you actually estimate that your project will get over within 3 years, record that variable consideration as a part of your total consideration and do the accounting. So conservatism is no longer a fundamental principle for us. What is more fundamental right now is a realistic principle of accounting. So the same principle applies in Ind AS 19 also when we are estimating leave encashment. जब लीव एनकैशमेंट का बात होगा, we are more keen on estimating the leave patterns of the entity.
Okay.
Okay.
Got it, sir.
So that is how the accounting has changed right now. All
Yes.
right.
Yes.
So
Thank you, sir.
Manish, समझ में आ गया? Yes. All
Sir,
right.
please unmute me.
You are unmuted only. All right. Fine. Fine. Uh, okay.
No, I mean mute कर दीजिए. Sorry.
अच्छा mute कर दो. Okay. ठीक है. All right. Fine. So now coming to the next one. So this takes care of leaves. I don't have much to discuss on this. You can go through these 3-4 questions for homework. Okay, I would want you to go through this one question, illustration 6. That is a particularly interesting one. 4, 5, you can go through this. Illustration 6, I want you to genuinely try this for homework. You can skip 4 and 5 for now. You can just browse through it later on. But illustration 6 is an exam standard question. So please go through this. It is something which we see in practical life. It is something which we see in practical life. हमने शुरू किया था taking one employee as an example, but illustration 6 is a very comprehensive question on leave encashment. Okay, the short-term absences. So go through this as homework. It sorts out all your queries. Okay, so coming to the next one. Profit sharing, bonus plans, you recognize the expense. All right. You recognize the expense in line with the terms of the employment that are there. Okay, so that's fairly simple. I don't have much to discuss on this. This also you go through for homework. Okay, all right. Now, coming to post-employee. So we are done with the first part, that is short-term employee benefits. Coming to the next one, this is your post-employment benefits, something that is very important. Okay. What do you mean by post-employment benefits? Benefits that come to the employee after he completes his employment. Now, let us understand. Let us understand. First April 2001. 1st April 2030. Okay. There is an employee. He joined an entity on 1st April 2001. And then he continued his service till 31st March 2030. That means 2001 से 2030 तक almost a 30-year experience. 30 years he has dedicated to the organization. Now, in line with the dedication, what the terms of employment had right from the beginning is, on retirement, he will get annual pension, he will get gratuity. Okay, these two things is what he is going to get. Gratuity is something that is statutorily imposed. Pension is something that was given at the time of joining itself by the entity. Now, what do you think? Should pension and gratuity be recognized after 31st March 2030, or should they be recognized in the 30-year period? What do you think? When should I book pension and gratuity? All right. Manish, what do you think? When should the expense towards pension and gratuity be booked? That's right, Abrakesh. Okay, Manish, बताइए. From the beginning, absolutely right. So this is where the understanding typically students confuse. Pension and gratuity is paid here, but pension and gratuity accrues in this 30-year period. Accrues in this 30-year period. Okay. So this is how it happens. This is how it happens. Now, the point is, sir, 30 years means he joins in the first year. When I have to understand his or her pension and gratuity, you know the amount of uncertain factors which are there. Enormous uncertainties. ये कोई छोटी मोटी certainty नहीं है. First one, will he be there in the organization for 30 years? That means attrition. Will he continue for the entire span of 30 years? Number one. Second, will he be alive for 30 years? Another one, mortality. Third one, जैसा है वैसा ही रहेगा और will he suffer any disabilities? So disability assessment. Fourth one, obviously salary of 1/4/2001 cannot continue till 31st March 2030. So salary कितना बढ़ेगा उसका? So inflation. Yes, salary will be how much? Inflation. Fifth, obviously, if he has joined as a junior executive on 1/4/2001, he cannot be a junior executive till 31st March 2030. Maybe he will retire as a managing director. Yes. So promotions. Yes. Promotions. All right. Next. Obviously, the benefits which are given on 1/4/2001 cannot be the same which is continuing till 31st March 2030. He can get additional benefits at that point of time. Yes. Now, all these uncertainties, is any of this related to accounting? Is any of this related to pure accounting? Bolo? Is attrition related to accounting? Is mortality related to accounting? Is disability related to accounting? Is inflation related to accounting? Is promotion related to accounting? And benefits, the nature of benefits that will be paid, is it related to accounting? Or will he remain in the same place, or will the place change? Location. So in all these cases, nothing is related to accounting. Nothing is related to financial reporting. This is something that I have to estimate in the future. This is something that I have to estimate in the future. Very complex. Very complex. That is why this particular section, post-employment benefits, is extremely important. Extremely important. Is it okay? In the entire standard, if something is critical, it is post-employment benefits. All right. So in all these cases, the accountant who sits in the office, he is not capable of judging all this. This is judged by a special category of professionals, which we are going to see shortly. All right. Now, so your post-employment benefits broadly get categorized into two heads. One is a defined contribution plan. Other is a defined benefit plan. Defined contribution plan, employer pays the contribution, story ends. Then at the time of retirement, the employee will go to the fund and draw the money. Very simple classic example, your provident fund. What do you do? Sir, employer contributes something, employee contributes something. After the retirement or end of service of the employee, what he will do is he will go to the PF authority. he will present his ID number, and then he will draw the money from there. PF invests that in some assets, okay, in some funds, in some shares, stocks, etc. Now the question is, those stocks may perform very well, those stocks may perform average, those stocks may perform badly. My point is, however those stocks perform, whatever be the return that the provident fund generates on the amount deposited by the employee, whose burden it is or who will enjoy it? Is it the employer who is responsible for this, or will the employee alone bear the burden of the returns that the provident fund generates? Bolo? Who is exposed to the risk? Who is exposed to the risk? Who is exposed to the risk? Yes, it is employee who is exposed to the risk. See, I have employer, I have employee, I have PF. Employer contributes every month. At the end of retirement, employee goes to the provident fund and says, I have retired, please give me my fund. PF authority, what will the PF authority give? The contribution plus returns. The returns can be anything between 8 to 10%, or sometimes even more, or sometimes even less. My question is, who bears the burden of this? Manish has said rightly, it is the employee. PF का काम है return generate करना. Ultimately, that generated return will be given to the employee who is drawing the provident fund. So now, when I talk about the employee, he will go there and he will collect whatever comes to him. He cannot say, why did you put in the PF? It is given only 6%. It is given only 7%. It has given only 9%. I am unable to beat inflation. You have to compensate me more. Can the employee say this to the employer? Answer is no. Employee cannot say this to the employer. Why? Because it is the burden of the employee himself. It is the burden of the employee himself. So this particular investment risk, it falls on the employee. It falls on the employee. Actuarial risk also falls on the employee. We will see what is actuarial risk shortly. Okay. Since it is only a monthly contribution, it is a straightforward accounting that happens. It is a straightforward accounting that happens. You don't have any discounting. You don't have any, what you say, you don't have any form of high complexities in accounting. Every month you accrue the contribution, pay it, story ends there. So straightforward accounting. Okay, employer has to contribute to the fund. That is his only obligation. After that, what happens? He is not really concerned with it. Okay, but in a defined benefit plan, what happens is the entity's obligation is to provide agreed benefits. In gratuity, there is an agreed formula to determine the gratuity. That is something that the entity has to provide. It cannot provide anything lower than that. If anything is lower than the agreed formula, then the employee can very well question the employer and take him to court if he refuses to make the payment in line with the agreed benefits. Are we okay with this? Yes. So investment risk plus actuarial risk, both of them fall on the entity. So here we are having complex accounting with actuarial assumptions plus discounting that happens. Are we okay with this? Yes. Any doubts so far? Anybody has any doubts? No. Manish, all clear? Yes. Just give me a minute. All right, let us continue. So clearly, defined benefit plan is very difficult to account. Okay, so all this theory you can go through. I will skip this. This is just for us to understand. Okay, you can go through these type of plans, whatever are there. Okay, insurance. Okay, so defined contribution plan, every month you are going to recognize the expense. If you pay something in advance, it goes to prepaid. Credit cash bank, credit accrued liability, just a PF payment entry that you are going to do every period. Okay, so that takes care of this. Okay, all right. Coming to defined benefit plans, pretty much what I have discussed with you. So here an employee joins an entity on 1/4/16, retiring 31st March 2050, total service period 34 years, reporting period suppose it is 2019-20. What are the uncertainties? Will he continue? That is the attrition. Will he live? That is mortality. Will he be physically fit? That is disability. You are making the payment here, but you have to book the expense here. That means you are making the payment after 30 years. So obviously the payout is happening after a substantially long period. You need to bring it to the present value. So what discount rate do I use? What about future salary increase? What is the benefit levels? You need cash after some time, after 30 years. Obviously, it will be a big amount. So, what do? You set the money aside in certain investments. So, those investments will generate certain income. What about the taxes on those incomes? And various other estimates to be made. So, all this makes it a very, very complex calculation. Okay. All right, go through this for homework. So, now when we talk about defined benefit plans, it is a four-step model. It is a four-step model. First one is determining the deficit or surplus, and this is the most important one. This is the most important step. After that, the outcome of step one will give step two, three, and four together. Step two, what should go in the balance sheet? Step three, recognition in the P&L. Step four, what should go to other comprehensive income. So step one is the basis for steps two, three, and four. Step 2, 3, and 4 is ultimately an output of step 1. What goes in P&L, what goes in balance sheet, what goes in OCI. All right. So when you talk about deficit or surplus, it is basically four sub steps which are involved. Ultimate cost of benefit, discount to the present value, fair value of plan assets, deficit or surplus is equal to present value of obligation minus fair value of plan assets. So you need two things in step 1. Present value of obligation, we call it as DBO, defined benefit obligation, and you need fair value of plan assets. These are the two things that we are looking at: present value of defined benefit obligations and fair value of plan assets. These are the two things. Now coming to present value of defined benefit obligation, words they call defined benefit obligation. That means what is the benefit obligation that you have agreed to pay. So when I talk about what is the amount agreed to pay, the amount I have agreed to pay becomes a cost to the entity. It becomes a cost to the reporting entity. And because it becomes a cost to the reporting entity, our first step is determining the ultimate cost of the benefit. Determining the ultimate cost of the benefit. And it is in determining ultimate cost of benefit that all those uncertainties get factored into. All those uncertainties get factored into. Uske baad, these benefits are payable in the future. So then you need to bring it to the present value. To bring it to the PV, discount rate kaun sa lagaoge? So that is the second one. So DBO is out of this step, the most critical one is present value of defined benefit obligation. Fair value of plan assets, these are the investments you have made, उनका fair value ही निकालना रहता है बस. Is it okay? Yes. Any doubts so far? Any doubts? No doubts? Okay. All right. So now coming to ultimate cost of benefit. Why it is difficult? There are multiple variables. Number one, there is a high degree of uncertainty. Number two, and it is a long period of time. Number three. Okay. The objective, accounting the benefits as they accrue. As they accrue. So how do we achieve this objective? Apply an actuarial valuation method. Who is an actuary? Actuary is that person who is qualified to ascertain these future variabilities. Who is qualified to ascertain these future variabilities. Are we okay with this? Yes. Attribute benefits to the period of service and make actuarial assumptions. Okay? So this is what the whole thing is about. So what do I do? What do I do is I am going to decide what is the ultimate cost of benefit, and then I will have to split it into small units for each year. I will have to split it into small units each year. So we call it as projected unit credit method. Projected unit credit method. Employee works for 1 year, he becomes entitled to 1 unit of that benefit. He works for 2 years, he will get entitled to 2 units of that benefit. 1 unit does not mean 1 rupee. Suppose he will be entitled to 1 crore of payout at the end of the 30 years or whatever is there. So 1 crore is not a sudden amount that comes and drops on the head of the employer at the end of the retirement of that employee. 1 crore is a gradual build up. वो धीरे 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 बढ़ते बढ़ते it reaches 1 crore. So suppose he has worked for 1 crore by 20 years. Suppose his payout is 1 crore and you are saying it is for 20 years. Then 1 crore divided by 20, that means it is accruing on an average at 5 lakhs per year. On an average at 5 lakhs per year. So 1 unit equal to 5 lakh. वो एक साल काम किया, he becomes entitled to 5 lakh. 2 years he has worked, 5 plus 5, 10 lakhs. Suppose he has worked for 5 years. So 5 lakh into 5, 25 lakhs. Okay. So each year काम करेगा, he becomes entitled. He goes further, he becomes entitled. So each of this is known as a unit. Each of this is known as a unit. I am ascertaining the future. So we call it as projected units. I am ascertaining the units that will accrue to him in the future. That is why projected unit. And these are the units which are getting credited to that employee. Which are getting credited to that employee. So projected unit credit method, PUCM. This is the method that we actuaries follow. Also, we call it as benefit upon number of years service, total benefit divided by number of years, or accrued benefit prorated on service. Accrued benefits prorated on service. Obviously, prorated on service. So we can call that also. So you are going to determine present value of defined benefit obligation, current service cost, and past service cost wherever applicable. Okay. So very simple. Attribute benefits to the periods of service. Okay. So this, you can go through this, these doubts, these questions. I have uploaded it on the portal. You can just check if it is there or not. Okay. I will not go through this right now, but I will just look at the application of whatever we have discussed so far. I will look at the application of whatever we have discussed so far with the help of one question. Okay. All right. Because that kind of makes things easy for us to understand. Okay. Then you can do the questions. It won't take time for us to understand. Okay. So when you talk about this question. Let us understand the applicability of this. Okay. This is a very simple question. Nothing is difficult in this. Okay. Acer Limited hired a professional in April 2017 for 6 years of service, which would terminate in March 2023. Apart from regular salary and annual bonus, Acer will pay a lump sum remuneration of 45 lakhs. Is this a benefit? Answer is yes. Is the amount known? Yes. So it becomes a defined benefit. Is it obligatory upon the employer to pay this? Yes. So it becomes a defined benefit obligation. DBO, agreed benefit. Can employee question the employer if she does not get 45 lakhs? Answer is yes, because as per terms of the contract, 45 lakhs was to be paid to her upon termination of employment. Discount rate used for actuarial valuations is 10% per year. Show how the obligation builds up over the employee's service. Ignore actuarial assumptions other than the present discount rate. Okay. So let us see how it looks like. See, first of all, what is the defined benefit obligation? Sir, 45 lakhs. What is the tenure? 6 years. That means each year the lady gets entitled to 7,50,000. Do you agree or not? Do you agree or not? Yes. Yes. Yes or no? Manish, there is nobody else. मनीष समझ में आया? Yes. Okay, let us proceed. So 7,50,000 per year is going to be the unit. So employee works for 1 year, 7,50,000. Second year, 7,50,000 into 2, 15 lakhs. Third year, 22,50,000. So ऐसे बढ़ते बढ़ते it reaches 45 lakhs. Now let us see whether you have understood this. The first year benefit of 7,50,000. When is it going to get paid? Is it going to get paid at the end of year one? Is it going to get paid at the end of year two? Or is it going to get paid at the end of year six? At the end of year six. That means I am on 31st March 18 and it is getting paid on 31st March 23. This is where students make a mistake. So be very careful. I have to discount it. They have given the discount rate of 10%. You tell me how many years are you going to discount it by? Are you going to discount it by 6 years or are you going to discount it by 5 years? Are you going to discount it by 6 or are you going to discount it by 5? 5 years, because you are at end of year 1, payment happens end of year 6. So end of 1 to end of 6 means beech mein gap kitna hai? The gap is 5 years. So I will do a discounting of 5 years. Discount. This is 4 years, 3 years, 2 years, 1 year. And end of year 6, no discount, because end of year 6 आप payment कर दोगे. So there is no discounting that will happen. Are we okay with this? Yes. So 7,50,000 into the discounting factor, 4,65,691. Any doubt so far? Any doubt so far in 4,65,691? Manish, समझ में आ गया बेटा discounting? Have we understood the first year? No doubts. All right. Year two, 4,65,000 is opening balance, but 1 year interest will come. Now you discounted by five. Now year two you have served, so the employee becomes entitled to 1 year of interest payout. Then 4 years discount, so 5,12,000. So this becomes your closing balance. So this is the way the closing balance is building up. This is the way the closing balance is building up. 4 lakh 65, 10 lakh 24, 1690, 2479, 34,9 and 45 lakhs. This is the way the closing balance builds up. So what is the entry that you are going to pass? Year one, employee benefit expense account debit to provision for employee benefits. Year two, this is technically not interest as in the nature of interest on borrowings, but I have just segregated for your understanding. So that also actually goes into employee benefits. So 5 lakh 12 plus 46, 569, 5 lakh 58, 829. So 1, 2, 3, 4, 5. This is how you are going to do the accounting. This is how you are going to do the accounting. Are we okay with this? Yes. Are we okay? Anybody has any doubts so far? Yes. No doubts? No doubts? Accounting, did you understand? So now let us look at this solution. Yes. So this is your unit of benefit. 7 lakh 50. 1 unit. That unit, when I discount it, it becomes what is known as my current service cost. It becomes what is known as my current service cost. Okay. It becomes what I know as my current service cost. Interest cost gets accrued. This is basically the present value which you are taking, you are unwinding the discount. So the total comes to 465, 1024. Like that, it goes on up till end of sixth year at 45 lakhs. Are we okay with this? Yes, are we okay with this? Yes. So that covers this illustration. A fairly neat and exhaustive illustration on the applicability of the defined benefit plan understanding. Okay. All right. So when you are computing ultimate cost of benefit, there are two assumptions that we do when you talk about actuarial assumptions. First one is demographic assumptions: mortality, employee turnover, proportion of plan members, proportion who will select the form of payment, claim rates under medical plans. These are demographic. When you talk about financial assumptions, discount rates, future salary, benefit levels, future medical cost, taxes payable by the plan, all of these go under your financial assumptions. Financial plus demographic assumptions together make up your actuarial assumptions. Can actuarial assumptions change in the future? Answer is yes. Can they change in the future? Answer is yes. My question to you is whether it is demographic assumption or whether it is financial assumption, does the entity have a control over that? Does the entity have a control over these assumptions? That's right. Manish, whether it is financial assumptions or whether it is demographic assumptions, does an entity have any control over this? Manish, no control. This is what happens outside. Company has no control. So इसकी वजह से whatever impact hits my profit, it has to get absorbed in other comprehensive income. And mind you, this is non-reclassifiable. This is non-reclassifiable OCI. So that takes care of this. All right. Determine deficit or surplus. Okay. So just go through this. Nothing much left to discuss. Okay. All right. Now, current service cost तक सब खत्म हो गया. We are all done with defined benefit obligation accounting. Okay, in the current period. जो कुछ भी current year में हुआ, that accounting we are all okay with it now. Coming next. Sometimes we are having a plan amendment. We could have a plan amendment. We could have a curtailment. We could do a settlement. Any of these things could be done. So when you have a plan amendment, what will happen is it won't impact the current. It will also go and impact the past service cost. Is it okay? It will go and impact the past costs also. That differential that comes, we will be taking it in the current period because of a change in estimate, but it is actually going to be treated as a past service cost. Is it okay? Yes. Yes, because here you are modifying the plan. So those, let us look at the way the accounting happens. Okay, let us look at the way the accounting happens. All right. You guys need a break, please let me know. You guys need a break, please let me know. I want you to go through this question. I want you to go through this question first. Okay. Go through this question. Okay, fine. Did you go through this question? Yes. So what is happening here? There is a lump sum benefit to be paid on termination. Salary in year one is 1 crore, assumed to increase at 7% per year. Discount rate is 10% per annum. Show the build-up of the obligation in respect of an employee who is expected to leave at the end of year 5. Ignore all other actuarial assumptions. Ratna Limited wishes to revise the percentage of benefit from 1% to 2.5%. Discuss the impact of this change if it was revised at the end of year 2 or revised at the end of year 5. Okay, so these are two things. Okay, so first part, let us break this into two parts. Okay, first part, is it same as previous question? Is it same as the previous one, that professional question? Yes or no? Bolo? Is it same as the previous one? Yes. So इसमें कोई change नहीं है. Second part में what is happening? Sir, second part में, is this an actuarial assumption that you are changing, or is it a modification in the plan itself? Is it a plan amendment or is it a change in actuarial assumption? Sir, plan amendment है. Okay, actuarial assumption नहीं है. You had planned to give him 1%, but you saw he's adding real value to the organization. So what you now say is, मैं उसको 1% नहीं दूंगा, I will pay him 2.5%. Sir, you are changing the plan. You are changing the plan. And because you are changing the plan, this will become a plan modification which will give rise to past service cost. It won't only give rise to current service cost, there will be a past service cost impact also, because you are changing the plan in year 2. So there could be a past service cost of year 1 whose impact you will absorb in year 2. Or if you are revising it at the end of year 5, the past service cost of years 1 to 4 will all cumulatively hit in year 5. You will not do a retrospective restatement because plan amendment has happened current year. You will take the impact retrospectively. Are we okay with this? Yes. Are we okay with this? Yes. So that takes care of this. So now let us quickly look at the way the question has been solved. So first one, let us understand the ultimate cost of benefit. Ultimate cost of benefit. See, salary in year 1 is 1 crore, assumed to increase at 7% per year, expected to leave at the end of year 5. What students do is, immediately 1 crore, 7% increase. So immediately they will write 1 crore into 1.07 raised to 5. The very first step goes wrong. For year 1, it is 1 crore. Then increase by 7%. So this becomes year 2. This becomes year 3. This becomes year 4. This becomes year 5. So therefore, it will be 1 crore into 1.07 raised to 4. So ultimate cost of benefit is 1 crore 31 lakh 7,960. Okay. So this is your ultimate cost of benefit. This is your salary at the end of year 5. So ultimate cost of benefit at the rate of 1% is 131,07,960 into 1% into 5 years. So that comes to 6,55,398. Ultimate cost of benefit. Ultimate cost of benefit. 6,55,398. Anybody has any doubts here? No. Manish, समझ में आ गया? Yes, no doubt still here. So now, ultimate cost of benefit, now I need to divide it over the period of service. So that comes to 1,31,080, 131,080. So this is the build-up of the what is it? This is the build-up of the ultimate cost of benefit. All right. Coming to measurement. Same thing, discounting happening 5 years. Sorry, not 5. This is to be paid at the end of year 5. So this will be 4 years, 3 years, 2 years, 1 year. Okay. So this is the build up. Accounting also we have done. Just go till here and tell me if there are any doubts. Any doubts till here? No, no doubts. All right. Let us move ahead. So first base plan accounting is done. Now there is a plan amendment. 1% ke badle mein you are going to get 2.5%. So the ultimate cost of benefit. Ultimate cost of benefit. So when I talk about ultimate cost of benefit, instead of 1%, we now use 2.5%. So it comes to 16,38,495. So this is the units. कितना होगा 327,699 per year. 327,699 per year. And this is the build up. This is the build up, regular build up. Okay, this is the regular build up. Till here, any doubts? I have not done anything new here. I have not done anything new here. Yes, all clear till here? Yes, all fine till here? Don't go to this as of now. Okay, I will explain how this has come. But until now, until here, is it clear? Yes. All right. Now, year two, the liability is 492,410. How much was it earlier? 196,964. 196,964. So does it give us that figure? 492,410 minus 196,964. 2,95,446. Did you get this? So this 2,95,446 is the increase in obligation because of plan modification. Are we able to understand this? This 2,95,000 is the increase in obligation due to plan modification. Yes or no? Yes or no? Yes. Now, because of this, since it is an increase in the liability due to plan modification, is it only pertaining to current period or is it also pertaining to previous periods? Yes. Is it pertaining only to the current period or is it also for the previous period? It is also for the previous period. See, look at this. 1.31 crore into 1% into 5 years or एक साल बीत गया. And now you look at this, it is 1 crore into 1.31 crore into 2.5% into 5 years. That means this is for the year that has passed by also. It is for the year that has passed by also. So therefore, it is not only the current service cost, this becomes the past service cost. This becomes the past service cost. Are we okay with this? Yes, are we okay with this? Past service cost. Yes, so 2,95,446 becomes my past service cost. So now, what entry you are going to see? Employee benefits to provision for employee benefits, employee benefits debit, finance cost debit, past service cost debit, and credit is provision for employee benefits. Okay. Then onwards, the new plan continues. Then onwards, the new plan continues. New plan. Here we have the changeover. Here we have the changeover. Yes. Are we okay with this? So we call this as past service cost. It is something within my control, so the hit will go to the profit and loss account. Yes. Abrakesh, is it clear? Yes. All right. Fine. So that takes care of this illustrative. Okay. Suppose if the a change happens in year 5, your change in the what you can say, your change in the liability will be 1638 495, 1638 495 minus how much was it here? 655 398. 655 398. So that comes to how much? 9,83,097. 9,83,097. Is this 9,83,097 going to give rise to past service cost, or is it current service cost? It is past service cost. 9,83,097. Yes, all clear? So 1, 2, 3, 4. This goes as per the earlier one. And then in 5, it comes to the past service accounting, the interest, employee benefits, everything remains. Yes. All right. So that takes care of question 10. Plan modification giving rise to past service cost. All right. Yes. Okay. So that takes care of the first step. Coming to the next one, we will then move on to what are plan assets and accounting for that. Okay. So until then, we can take how many minutes break do you take? Okay, so we'll take a 10-minute break. It's 8:35. So we reconvene at 8:45. Okay, then we are almost done with India's 19. Then I quickly brush through India's 12 and we are done with it. Okay, all right, take a quick break, please. 10 minutes. Manish. Yes, all right. So let us continue. So coming to our discussions. All right. We saw the first part, that is determining the ultimate cost. Determining the ultimate cost of the benefit. Now we move on to the next part. The first part is done, determining the ultimate cost. Now we move on to the next one, that is plan assets. That is plan assets. Okay. So what happens is it mandatory to have assets? Answer is no. It's definitely not mandatory. Even the standard does not require it. But is it advisable to have? Answer is yes. Because these result in enormous payouts at the end of the employment that generally such liquid cash won't be available with the entity. And because of this reason alone, it is advisable to have something known as plan assets. What do you mean by plan assets? Basically, the entity will set aside money and put it in certain investments. It could be fixed deposits, it could be equity also, it could be mutual funds, it could be government securities. Typically, you put it in less risky ones like government securities and fixed deposits. You will generally not prefer something as volatile as equity, but a small percentage you could consider. Again, the standard does not specify anything. Even if you don't put the money there, standard is okay with it. Okay. So you could have an obligation without an asset backing, perfectly fine. Or you could have an obligation that is funded. That means it has asset backing. Now, how do I do the funding? Either I could create a separate fund. That means investments are held by that entity, and these investments to be used solely for payment or funding of employee benefits. Even in the time of bankruptcy, these funds will be available only for employee payments and not for anything else. Okay. Or you could take a qualifying insurance policy, and the proceeds from the policy are to be used only for employee benefits under defined benefit plans. So this is what is the manner in which you can do the funding. If you recollect, we had something like a debenture redemption fund or a sinking fund when you studied redemption of debentures under the and in your CA intermediate, right, or CA foundation. Okay, these investments are only called as plan assets. Why plan? Because it is pursuant to a defined benefit plan, and therefore we call them as the plan related assets or simply plan assets. Okay. So, just to avoid the risk of cash not available, it is advisable to have the plan assets. And since they are investments, typically you would go for a fair valuation. Typically, you would go for a fair valuation. Now, when I talk about plan assets, what do you mean by the return on plan assets? Okay, what do you mean by the actual return on plan assets in respect? Okay, so let us calculate how they do that. Okay, all right. This is the same question. Compute actual return. Benefits paid is 5 lakhs. Employer's contribution 7 lakhs. End of the year fair value is 2850. Opening value is 20 lakhs. Very simple. Opening is 20. Closing is 2850. Benefits paid means you will obviously liquidate the investments. So 5 lakhs will be credited. Employer's contribution, this is what you add to the fund. So the balancing figure of 6,50,000 is the surplus that you have generated. It is the surplus that you have generated. Or you can put the same thing in a statement form, you will get the same answer. Okay. So this is the actual return on plan assets. Your actual return on plan assets could be a combination of increase in fair value as well as actual interest or dividend that is paid out by those assets, that is paid out by those assets. All right, so that takes care of this one, plan assets. Okay, what do you mean by deficit or surplus? You are having liability. which is my defined benefit obligation. You are having assets, which is my plan assets. These assets are going to be used exclusively for defined benefit obligation. So therefore, what the standard tells is you net off for presentation purposes. For presentation. So therefore, when you talk about calculating deficit or surplus, you will have present value of defined benefit obligation, which we have already seen, minus the fair value of plan assets, minus the fair value of plan assets. If the figure is positive, it is a deficit. That means your liability is more than the asset. So it becomes net defined benefit liability. And if it is less, that means if it is negative, then your position is a net asset. So net defined benefit asset. Is it okay? So this is how you are going to present. All right. So this you can just go through this for your understanding. Okay. All right. This is what I have discussed already. You can go through it. All right. Fine. Okay. So how to present? Just go through this for homework. Not very important at this stage. Okay. So coming to step number 1, we did. Step number 2, we did. Step number 3, in the P&L, we have current service cost that goes. We have seen examples. Past service cost also I have taken you through that, which arises on account of plan amendment. Curtailment means reducing the benefits of the plan. वो भी जाएगा past service cost में, P&L में. Gain or loss on settlement, we will see that. That also goes through the profit and loss. Okay. Now, these plan assets that you are having, that is also generating interest. The defined benefit obligation also records unwinding of discount. That means interest. So you have on one side interest on defined benefit obligation, and you have interest on plan assets. Obviously, one is an income, the other is an expense. So you are going to present it as a net of each other, and it will be shown in the P&L. So interest on defined benefit obligation, this is the unwinding of discount, which you have already seen similar cases. And interest earned on plan assets, this is calculated at the discount rate. This is calculated at the discount rate. So you are going to present it net, so that the net figure goes in your profit and loss. And sometimes you would be having remeasurement of the net defined benefit liability. Actuarial gains or losses, return on plan assets, change in effect of asset ceiling. These amounts will go to the other comprehensive income without reclassification to the P&L. Okay, that's it. Net interest, you can go through this theory, not much for discussion today. Okay, remeasurement of net defined benefit liability. All right. So that's it. So let us see. All right. Fine. I will take you through question number 13, and then we come to question number 12. Okay. All right. Question number 13 is interesting because it talks about same question, Ratna Limited, salary 1 crore. I have kept the same figure so that you can appreciate the way the treatment changes because of change in some factors. Okay. So salary in year 1 is 1 lakh, assume to increase 7%. So this figure you are already familiar with. Ignore all actuarial assumptions other than the given discount rate. During the second year, based on the performance of the employee, Ratna Limited expects that the last drawn salary of the employee will be 1.5 crores and not 1 crore. What will be the impact of this change? Discuss with suitable journal entries. Okay. What is happening? What is changing, first of all? Is the benefit that will be paid out, the percentage, is this percentage changing or is the expected salary itself changing? Is the benefit changing or is the expected salary changing? And if the expected salary is changing, is it a change in the plan or is it a change in actuarial assumptions? Is it a change in the plan or is it a change in the actuarial assumption? Okay, all right. Is it a change in plan or is it a change in actuarial assumption? It is not a change in the plan. Plan change will happen where the employer has the control. जैसे 1% became 2.5%. We call this as a plan modification. Look at the language. Ratna Limited expects the last drawn salary. If I had to change the plan, why will I use the word expects? If the employer had to change the plan, why would they use the word expects the last drawn salary to be 1.5 crores? You don't expect something over which you have control. So here there is no control. Probably the employee is so precious and valuable that if he does not get this salary, he will easily switch over somewhere else. So that is why you expect his salary to grow to 1.5 crores. It includes your inflation, it includes his skills. It is a combination of multiple things to prevent his attrition. So all these things are basically your items not under your control, and therefore it becomes an actuarial assumption. So there is a change in actuarial assumption. So till here, I don't have to explain anything. It is exactly the same. Now what happens is, in year one, your salary was 1 crore, then it became 1.5 crores. So the benefit on termination is actually 7,50,000. 7,50,000. So when I talk about 7,50,000, the build-up is 1,50,000 each year. So this is how the benefit builds up. This is how the benefit builds up. And this benefit has built up and been changed. I mean, this benefit has come into existence right from year two. So your liability in year two went from 196,964 to 2,25,394. So your liability has gone up by 28,430. Your liability has gone up by 28,430. Are we okay with this? Yes, 28,430. Where will this go? This is a change in actuarial assumption. And because it is a change in actuarial assumption, it will go to other comprehensive income under actuarial loss. So this will be employee benefit expense account debit 98,482. Yes, the first one. Interest 8,953. So that is the same one. These two getting recorded there. OCI actuarial loss 28,430 and credit provision for employee benefits 1,35,865. Yes, going forward, the new plan itself will be applicable. Going forward, the new plan itself will be applicable. Are we okay with this? Yes, are we okay with this? Yes. Any doubts? Anybody? Yes. No doubts. Okay, fine. Manish. Okay, so that takes care of question 13. Coming to question 12, Bharat Power Limited, company with a turnover. This is little comprehensive. Company with turnover of this many crores, large employee base, provided defined benefit plan. The following information pertains to balances of funds, assets, and liabilities. So you have the liabilities opening and closing. You have the plan assets opening and closing. Service cost 1.65 crores. Contribution of 3.33 crores to the plan. No benefits were paid. Consider discounting rate of 8%. Compute the balances of the company to be included in its balance sheet and amounts to be recognized in the statement of profit and loss and other comprehensive income. Give the journal entries. Very simple. How do we approach this? So what you could do is you could prepare two accounts. I will tell the easy and long way, then I will tell the short way. You can do whatever you are comfortable with. So what I normally do is I prepare a plan assets account जहाँ पे I am given the opening balance 3,420, 3,825. So opening balance 3,420, closing balance 3,825. Benefits paid is zero. Employer's contribution, they have given 3.33 crores, that is 333 lakhs. So the balancing figure is a surplus, 72. Balancing figure is a surplus. Coming to obligation, you are given opening balance 4,200, closing 4,740. These two are given. Coming next, current service cost 165 is given in the question. 165. Interest cost. This is obviously based on the opening balance 4,200 into 8%. So the balancing figure is going to be your actuarial loss. Balancing figure is going to be your actuarial loss. Are we okay with this? Yes. Are we okay with this? Yes. So quite simple, nothing complex. Okay. All right. Alternatively, these two accounts, you can present it in this particular manner. You can present it in this particular manner. Okay. All right. Next. But how do I present it in the financials? First is opening, you present it net liability. That means DBO 4,200 minus 3,420. So that comes to 780. Next. Next, net interest expense on the net defined benefit obligation debited to the P&L. Net defined benefit obligation is 780 into 8%, so 62. Closing net liability 4740 minus 3825. So that comes to 950. Increase in liability. Closing net liability 950 minus opening net liability 780, so 135. Remeasurement, that is whatever is the balancing figure actuarial loss, 72 less interest on 3,420 at 8%, so 274. 72 minus 274, 202, and net remeasurement is equal to 202 minus 39, 241. So what are you going to present? P&L account debit 227, other comprehensive income 241, to cash 333, to net defined benefit liability 135. P&L, you have the service cost and you have the other comprehensive income. That's it. Okay, so that covers your overall manner in which you do the presentation. Any doubts here, please ask. Anywhere you are stuck up, please feel free to ask. Okay. No doubts. Manish? All right. So we take it as no doubt. So that is why this question is important. Just go through this to see how the presentation happens. Okay. All right. Rest, I think you can go through these questions by yourself. Go through this one in particular, Arunachalam Limited. Very interesting question. Okay. All right. Fine. Okay. Disclosures. All right. Other long-term benefits, similar like a service reward. So you treat it exactly the way you do the deficit or surplus reimbursement, right? Recognition in P&L. No major change because this is also long term discounting to karna padega. Okay. All yes. Termination benefits. When the employee gets retrenched, these are the benefits that get paid to him. So this also you can run through. Okay. All right. So appendices A and B, just theory. You can run through it. Nothing much for me to explain as far as in days, I mean, appendices A and B are concerned. They will take by themselves a whole amount of time. So with this, we conclude whatever is the key point, whatever are the key points for Ind AS 90. Any doubts, Abrakesh? Any doubts, Manish? Yes, before we move on to Ind AS 12. ESOPs is a separate standard, Ind AS 102. Have you studied Ind AS 102? Okay, so it will be a part of the session then. Okay, they will be sharing, so you will be having ESOPs also as a part of the discussion. All right, any other doubts in Ind AS 19, Manish? See, this is more as a refresher of what you have already studied. So that is why I just rushed through the main questions and closed it. Ideally, this is a 3-day topic that we normally have, but I think presume that it has already been discussed. Okay. Yes. Abrikesh. Yes.
Yes, sir. In case of payment of gratuity,
Yes.
there is a provision in the Gratuity Act that suppose an employee joined on a year one,
Correct.
and if he dies before the completion of year five, which is
Okay.
a precondition for payment of gratuity,
Yes.
even in that case, the employer has to pay make the payment of gratuity,
Hmm.
considering that he is going to retire at the particular age, 58 or 60. So
Okay.
in that case, how this will be presented?
See, I think
It is a demographic change, I suppose.
that will be a demographic change. It will run through your other comprehensive income. Yes.
No, but the total amount, because suppose in third year he dies,
Okay.
from third year to 60 years or 50 years as the company policy. So
Okay.
for gratuity will be paid as a half month salary for the 57 years.
Yes. Probably something. I mean, it won't be 57. Whatever 20, 30 years, whatever he would be serving. If that is the provision, yes, you would be going
This
ahead
is
with.
a provision in the act actually, payment
I
of
know, I
gratuity.
know, I know. Provision in the Gratuity Act. So whatever it is, so that is why I read one of your queries where you mentioned 5 years that you don't normally make a provision, which is not the case. Okay. If
Yes.
suppose you join an entity today itself,
Mhm.
we make a gratuity provision in your case also, though you have just joined and have not completed 5 years.
Yeah, yeah, that I realized once you go went through ahead.
Yeah.
So that I understand.
So that way, those provisions will always exist in your books. So you can always make the payout to that particular individual. That won't be an issue.
So entire amount will be on, I mean,
See, you
P&L
have to see
or
the
OCI.
statute. You have to see the statute. Whatever the statute requires, you will have to do that. Okay?
Yes, sir. Okay. Thank
Yes.
you, sir.
All right. Yes. All right. Anything else? मनीष और कुछ पूछना है? Any other doubts in Ind AS 19, or we move on to the next standard? All clear? तो आगे बढ़ते हैं. That anyways concludes our Ind AS 19. So good. So we could complete that. All right. Yes, RK, tell me, you want to ask something? Okay. The biggest difference that we could see between AS 15 and Ind AS 19 is that under the accounting standard 15, your items would everything go and sit in your profit and loss account, whether it is actuarial gains or losses, or whether it is, plan change, plan amendment, past service cost, everything. But unlike that, in the case of Ind AS 19, we are having certain payouts that exclusively go and sit in your other comprehensive income. That has a lot to do between what you have actually seen in the format of the P&L. Okay. Apart from that, if you look at the differences, well, in Ind AS 19, even constructive obligations are considered, whereas in AS 15, there is no such specific reference. Employee includes directors in Ind AS 19, but the term employee includes only whole-time directors. So here, even probably you would also end up including non-whole-time directors. Okay. Definition is different in Ind AS 19 pertaining to short-term employee benefits. Then you are having deals with multi-employer plans. So you have two, three entities together join hands for a employee plan. AS 15 does not have that. Risk sharing plans are there here. There it is not there. You can read the theory. Past service cost recognized as an expense at earlier of plan amendment or curtailment. Here it is recognized on a straight line basis until the benefits become vested. And if already vested, you book the expense immediately. So that is how it happens. Encourages usage of actuary. But in AS 15, neither requires nor specifically encourages the usage of the actuary. Actuarial valuation, detailed actuarial valuation to determine the present value of net defined benefit liability. This is to be carried out at least 3 years, and fair value of each asset determined at each balance sheet date. Actuarial gains or losses booked in other comprehensive income. In this case, it goes and sits in the P&L. Okay. Financial assumption based on market expectations. Ind AS 15 is silent on the same. Discounting of post-employment benefit obligations. Timing of recognition of termination benefits. That's it. So these are the broad differences between Ind AS 19 and AS 15. Okay. Thanks. Okay, so that takes care of our case query. Anybody else? Any other query? Doubts? No. All right. So that concludes this particular topic. Okay, we quickly run through Ind AS 12, that is income taxes. Very important from a practical perspective, because income tax is something that is a certainty. So accounting for income tax becomes mandatory. Why do I have this particular standard? Because the income tax follows its own method of computation based on the tax rules. Okay. Whereas accounting follows accounting principles. Okay. So because of this, there is generally a mismatch between accounting profit and taxable profit. If you remember your statement of total income that you prepare for the purpose of taxes, your statement of total income starts with net profit as per the books, and then you go on doing the adjustments, allowances, disallowances, depreciation, all these adjustments you do and arrive at total taxable income on which your tax is applied, on which your tax is calculated. So there is a mismatch between the very profit number on which tax is calculated. And because of that, you are having this particular standard on income taxes. Okay. So suppose your book profit is 1 lakh and your taxable profit is 1,10,000. Tax rate is 30%. So you would be paying a tax of 33,000. But a reader of financial statements will say 1 lakh into 30% is 30,000. Then why have you paid 33,000? That is the question that he will always have. And because he has that question, he will end up asking this question to you, and you will have to explain this in your financial statements. That is why you have this particular topic. Is it okay? Yes. So, you are going to recognize the tax impacts in the P&L, in the other comprehensive income, in the reserves. Basically, wherever you have an element of tax, you will recognize it at the place where the original transaction was recorded. This was not much of an issue under ICAI because everything was routed through the P&L. But here you have some things routed through the P&L, some things routed through a statement of changes in equity, some things routed through the other comprehensive income. So jahan kahin bhi jana hoga, you will have this movement on account of taxes also going there. Okay. So couple of definitions. First one, profit or loss before deducting tax expense, that is your accounting profit or loss, that is basically your PBT. Okay. What do you mean by taxable profit or loss? In accordance with the applicable tax rules. That means as per the computation of income. Next, tax expense, tax income is nothing but current tax plus deferred tax. What is current tax? Basically, computation of income what you draw. Based on that, the tax liability that you determine, that will become your current tax. That will become your current tax. Taxable profit multiplied by tax rate. Taxable profit multiplied by tax rate. What will be the accounting treatment for this? Expenses in P&L account debit. Expenses in P&L account debit, and credit provision for tax. Credit provision for tax. This is the amount expected to be paid to tax authorities. Amount expected to be paid to tax authorities. Are we okay with this? Yes, are we okay? Next. Okay, so just go through this illustration. I have already shared this. Okay, this is essentially a statement of total income that I have tried to prepare. Okay, don't see when you are studying income tax. Okay, when you are studying Ind AS 12, don't bring into picture the Indian Income Tax Act. Okay, don't bring into the picture. Instead, focus on financial reporting alone and think about tax adjustment from a reporting perspective. What happens is many times we think 43B is like this, 40A1A is like this, 40A1 is like this, 80G is like this. All those things are not important in Ind AS 12. See, what is the source of Ind AS 12? IAS 12. What is IAS 12? The IFRS standards, International Accounting Standards. Now, if it is international accounting standards, my question is, if it is international accounting standards, my question is, why do we look at income tax of a particular country in that case? It's not required to look. All you need is to be sound on the fundamental principles of financial reporting. If you know that, then whether it is Indian income tax, Mauritius income tax, any country's income tax, you know how to give the accounting impact. So what do you say, concerned with the reporting impact. Okay. So what you are given is, you are given the accounting profit and loss and other comprehensive income. Okay, you are given this. This is as per books of accounts. And then you are given depreciation for this year as per books was so much, as per tax record so much. Okay. Then you are given product development cost incurred. What is the tax treatment for that? Then you are given trade investments not allowed by tax authorities, fair value adjustments. Bad debt provision is given, and what is the impact under the tax laws. Inventory obsolescence is there under Ind AS 2, but this provision is not tax deductible. Government grants not taxable. H Limited increased a liability for product warranty cost by INR 1,75,000. Not tax deductible until the company pays the claims. Introduced healthcare expenses allowed only when benefits are paid, but in line with Ind AS 19, recognized in profit or loss when employees provide the service. Penalties not deductible. Tax laws to deduct expenses for petrol up to 1,40,000. H had 4 vehicles in 7-8 and total petrol expenses amounted to 7,21,000. So basically, you are given the P&L, you are given all the tax adjustments. So what you will be doing is start with the accounting profit and then move to determine the taxable profit. So current income tax 28,14,000. 28,14,000. Are we okay with this? Yes. RK, have you understood? Yes. So basically, you are preparing statement of computation of total income. That's it. All right. Fine. Okay. So isme I don't have much to continue. So go through this question for homework. All right. Fine. Okay. What is deferred tax? Amounts of taxes payable or recoverable in the future in respect of temporary differences. So carrying amount multiply or temporary differences arises on account of difference between carrying amount and tax base. So multiplied by the tax rate. So that gives you the deferred tax. Okay. Now you will be going through question number 2 and question number 3. I will take you through one of it and you will go through the other one by yourself. Okay. So this is question 2. TriStar acquires a machine for 8 lakhs, decides to depreciate it straight line over 5 years. Just a minute. All right. So, TriStar acquires a machine for 8 lakhs, decides to depreciate it straight line over the full life of 5 years. IT legislation allows depreciating machines straight line over 4 years. In years 1 to 5, the TriStar Limited's taxable income before tax depreciation is 4 lakhs and tax rate is 30%. Show the current tax expense, deferred tax expense, DTA, DTL, and the net profit in years 1 to 5. So very simple. First one, accounting. Carrying amount and book depreciation means this is FR Ind AS. We are having opening carrying amount 8 lakhs. Each year depreciation 5 years 1,60,000. So that comes to 6,40,480 and ultimately it becomes 0. Net profit without tax depreciation. Net profit without tax depreciation. Okay, just looking at the situation as it is, your income is 4 lakhs. Accounting depreciation is 1,60,000. So your profit before tax should be 2,40,000 each year. At the rate of 30%, tax should be 72,000 each year. So net profit should be 1,68,000. Till now, anybody has any doubts? RK, Manish, Abrakesh, any doubts till now? No doubt. Okay. Till now, it is clear. Okay. Abrakesh, any doubts? No. Okay. Now, let us look at the income tax. Let us now look at the income tax. Income tax allows depreciation over 4 years. So 2 lakhs each year. So your current tax expense will be 4 lakh taxable income. It is this one actually. Okay. 4 lakh each year. Less tax depreciation to 2 lakhs and in year 5 0. So 2 lakhs each and in year 5 4 lakhs. So current tax expense will be 60, 60, 60, 60 and 1,20,000. Yes. Is it clear? Is it clear till now? Yes. All right. So now when you look at the net profit actual, it looks something like this. This is your income. This is your depreciation. Profit before tax, 2,40,000 in each year. Tax expense as per computation. This one. 60, 60, 60, 60, 120. So net profit is this much. Now you will have a query. Sir, last year your net profit is 1,20,000, but for 4 years it is 1,80,000. This is because the tax expense has doubled in year 5. Yes, this is because the tax expense has doubled in year 5. So my question is, what do you have to say about this? My question is, what do you have to say about this? Is there anything that is visible to you? Is there any gap, any anomaly, any aberration, any mismatch that is visible to you? See, is there any mismatch? See, ideally, my profit is the same, 2,40,000. But this is my tax expense. Is there anything visible to you? Any mismatch, any inconsistency, any aberration, any anomaly? Abrakesh, that's right, RK. Yes. Yes. See, put yourself in the shoes of the reader of financial statements. He will be happy in year 1, 2, 3, 4. बोलेगा 2,50,000 के सामने 60,000. Very comfortable. In year 5, we will ask, why did you pay 120? 50% of the profit went into income tax. Why? Regulations did not do that increase. So naturally, he will ask. So here there is an inconsistency. Here there is an inconsistency. Yes. So now what is happening is your tax. Look at this column. There is a difference of 12,000 each year. Yes. And In the last, there is a difference of 48,000. Yes or no? Do you agree to this? Yes. So your tax difference is 12,000 in the first 4 years and minus 48,000 in the fifth year. So difference in profits is minus 12,000 in the first 4 years and 48,000. Can you say that the difference of the first 4 years is getting reversed in the fifth year? Can you say this? Yes, the difference of the first 4 years is getting reversed in the second. Can you say this? Yes. Yes. So if I just account for tax expense as 60, 60, 60, 60, 120, is it actually correct? Is it actually correct? Or is there a problem because of this? Am I actually having reduced tax initially, or have I postponed this tax by 12,000 to the next period, to the fifth period? Are you able to understand? ये जो tax expense है 60, 60, 60, 60, have I actually am I actually liable for a lower tax, or have I only postponed this tax to the future? RK, you have only postponed. You have only postponed this tax to the future. आपने इसको खाली postpone कर दिया. And therefore, यही होता है postpone का other word क्या है? What is the alternative word for postpone? Deferred. So you are deferring your tax. You are deferring your tax. Postponed tax does not match the sophistication required from professionals, right? तो इसके लिए उसका नामकरण कर दिया deferred tax. Okay, they called it as a deferred tax. So this 12,000 which you have paid less each year has actually been paid in the fifth year as 48,000. So therefore, your deferred tax expense that you need to book each year is 12,000. And in the fifth year, that deferred tax will get reversed, 48,000. So therefore, your P&L actually looks something like this. 4 lakh, accounting depreciation 1 lakh 60, PBT 2 lakh 40, current tax expense 60,000, deferred tax 12,000, so net profit 1 lakh 68. Profit before tax is the same. Net profit after tax also is the same. Deferred tax में we are taking the impact. Deferred tax में we are taking the impact. Are we clear with this? Yes. Do I have any doubt so far? Yes. Abrakesh, did you understand? No doubts. Okay. So this is the normal working that you have. This is the normal working that you have. We call this as a P&L based approach. We call this as a P&L based approach. Q P&L based? Because you have seen I have taken the P&L and I have done the work. I have taken the P&L and done the work. But what Ind AS 12 tells us is you cannot take the P&L approach. You have to take the balance sheet approach. So the same question, same numbers, let us look at a balance sheet based approach and do the question. Okay. So let us have a look at that. 1 second. All right. So this is the same question. TriStar Limited acquires a machine for 8 lakhs. Useful life 5 years. Tax depreciation over 4 years. So calculate the deferred tax expense. So now let us understand the balance sheet approach. So taxable income 4 lakhs. depreciation expense 2 lakhs each year. So current tax expense 60, 60, 60, and 120. This is exactly what we have taken from the previous one. This is exactly what we have taken from the previous situation. Okay. Coming next to deferred tax. What is the carrying amount of my asset? Carrying amount is essentially value as per the books. So carrying amount minus depreciation expense gives you the closing carrying amount. 640, 480, 320, 1 lakh 60 and 0. So this is your carrying amount. What is your tax base? What do you understand by tax base? Tax base is nothing but the value that of that asset or liability for tax purposes. Value of asset or liability for tax purpose. Tax purpose के लिए 8 lakh minus 2 lakh. First year it is 6 lakhs, then it is 4 lakhs, then it is 2 lakhs, and in year 4 and 5 it is 0. In year 4 and 5 it is 0. Is it okay? Yes. Any doubts? Any doubts? Carrying amount and tax base समझ में आ गया? See, for tax purposes, the depreciation is 2 lakhs each. Yes, because 4 years ka useful life, 8 by 4, 2 lakhs. So first year, 8 minus 2, 6, 6 minus 2, 4, 4 minus 2, 2, 2 minus 2, 0. Did you understand? Yes. So tax base is nothing but value attributed or computed as per tax laws. Value attributed or computed as per tax laws. What is carrying amount? Value as per financial reporting, in our case Ind AS, or you can just remember it as GL balances. You can remember it as general ledger balances. Are we okay with this? Yes. So you are having carrying amount 6 lakh 40, 480, 320, 160. Your closing taxable basis, tax base, sorry, not taxable base, tax base 6, 4, and 2. So what is the difference? First year, the difference is 40,000. Then it is 80. Then it is 120. And finally, it is 160 before it comes to 0. Before it comes to 0. Are we okay with this? Yes. Are we okay? Any doubts? No doubts? आगे बढ़ते हैं. So this difference is on the closing balance. Yes or no? This difference is on the closing balance. ये closing balances है. Is this a temporary difference or a permanent difference? Sir, temporary. कैसे मालूम? देखो ना. Year 5 it is becoming 0. Year 5 the difference is becoming 0. That means difference is going away. By end of year 5, tax base also is 0. Accounting base, I mean carrying amount also is 0. So therefore, this is a temporary difference. So this gives rise to a closing deferred tax. This gives rise to a closing deferred tax at the rate of 30%. So 12,000, 24,000, 36,000, 48,000 and 0. Is it okay till now? Why it is a liability, I will explain. Right now, I am only saying it is a closing deferred tax. ठीक है? Is it okay? Yes. RK? RK, what is your full name? Okay. All right. Fine. So your closing deferred tax liability. Your okay, Rahul. Yes. All right. So coming to the difference. First year 12. Second year closing is 24. So 24 minus 12, 12. 36 minus 24, or if you are comparing it with the original, 36 minus 12, 24, 48 minus 12, 36, and this becomes minus 48,000. So 12, 12, 12, 12 minus 48. Have you seen this 12, 12, 12, 12 and minus 48? Yes, it is the same reversal that you are seeing here. It's the same reversal that is coming here. Are we able to follow? Are we able to follow? Yes. Yes, all right. Now the question is, sir, why is it a liability? Why is it a liability? Okay, understand this. ये एक समझ लोगे, you will be very comfortable to understand in the future. Okay, so look at this. My carrying amount is 6,40,000. Tax basis 6 lakhs. Okay. That means what? As on today, in the future, I can expense out 6,40,000 in the books. By way of depreciation, I can expense out 6,40,000. Yes or no? Yes or no? In the future, I can utilize a depreciation value of 6,40,000 for finance purpose, for accounting purposes. But in the future, the tax deductible depreciation is how much? In the future, the tax deductible depreciation is how much? Is it 6,40,000 or is it 6 lakhs? Is it 6,40,000 or is it 6 lakhs? It is 6 lakhs. In the future, you can get only a deduction of 6 lakhs against the taxable profits, not 6,40,000. Yes or no? That means you will expense out higher in the books, but against those assets, you are going to get a reduced depreciation. And because of this amount that will be expensed in the future, because of this amount that will be expensed in the future being lower, you will end up paying higher taxes in the future. You will end up paying higher taxes in the future. Are we able to understand this? Yes. Are we able to understand this? Yes. Dekho, against 6,40,000 depreciation of the future, you can get only 6 lakh as a tax deduction. And therefore, because of reduced deduction in future, you will have increased profits in the future. And because of increased profits, you will have increased tax liability. So it gives rise to a deferred tax liability. It gives rise to a deferred tax liability. Are we able to understand this? Yes, Abrakesh, did you understand? Yes, all right. So Rahul has given the rule. I'll come to that shortly. Okay, I'll come to that shortly. Yes. So this is the meaning of balance sheet based approach. Final result is the same. Only thing is, in first case, we were looking it from the lens of a P&L. Here we are looking at it from the lens of a balance sheet. And Ind AS 12 always requires us to evaluate from the lens of a balance sheet, not from the lens of a P&L. Okay. So that is the same. So I want you to do the remaining questions. This is done, homework. I want you to do this one as a homework. Okay. All right. Now, so when you come to deferred tax, it is a 10-step model. First one is calculate carrying amount of assets and liabilities. This is as per Ind AS. Compute tax base. This is as per tax laws. Compute temporary differences. This is 1 minus 2. Classify temporary differences into taxable temporary difference or deductible temporary difference. Identify any exceptions. दो तीन exceptions है. Assess deductible temporary differences, tax losses and credits. determine tax rates, calculate and recognize deferred tax, accounting of deferred tax. Okay. And finally, offsetting DTA, DTL, and comply with other requirements. So these are the 10 steps that you have to follow. Yes. All right. Any doubts? No. Okay. So for this purpose, I want you now to just proceed to understand what is carrying amount. There is one question. Then I want you to solve. Yes, I want you to solve all these questions as homework. Okay. All right. Calculate uh, calculation of tax base. Okay. Computation of tax base. All right. In certain specific cases where items have a tax base but are not recognized in the balance sheet, tax base of an asset or liability is not immediately apparent. Okay. All right. So that is what you are going to do. Okay. Go through this homework. And then the very first example that we saw, where you have to prepare a statement of total income and do the calculation. Based on that, you calculate tax base of its assets and liabilities. Note that statement of financial position has been adjusted by the current tax expense and liability, which is given on the next slide. Okay. Statement of financial position. You are given the balance sheet. You are given the notes. Yes, so that is what you will have to do. Third step, compute temporary difference, which is basically the difference between carrying amount and the tax base. Yes, what do you mean by temporary differences? Temporary differences means differences which temporary differences means differences which get closed in the near future. Okay, there is a visible path for that closure. Okay, so that gets closed, then your temporary differences are done. Okay, all right. So coming to identification of DTA, DTL, where is revaluation difference? Revaluation is there now. Ind AS permits or requires certain assets to be carried at fair value or to be revalued, which may not be permitted for tax purposes, giving rise to a temporary difference. Now, coming to identification of DTA, DTL, very simple. If carrying value is greater than the tax base, then look at the underline. If that is an asset, it becomes a DTL. It becomes a DTL. And underlying, if carrying value of is greater than the tax base of a liability, it becomes a deferred tax asset. It becomes a deferred tax asset. Okay, carrying value less than tax base of an asset, it remains a DTL. Carrying value less than tax base of a liability, it remains a DTL. That's it. Carrying value equal to tax base, there is no deferred tax. No deferred tax. Are we okay with this? Yes, this is very important too. This is very important to remember. Is it okay? Rahul? Okay, fine. So just go through these examples for homework. Acha, had they played the session? Okay, all right. All of this, I leave it for homework. There are a lot of examples which are there. Okay. All right. Now, so we start off with identifying carrying amount, tax base, temporary differences, and then we then move on to identifying exceptions. On some items, you cannot recognize deferred tax. First one is goodwill arising in a business combination. On this goodwill, it will not have a tax base, but it is having an accounting base. So it will not recognize. It will not recognize the DTA or DTL in certain cases. The first one is initial recognition of goodwill. Do not recognize the deferred tax liability. Relating to initial recognition of goodwill, example impairment loss, do not recognize uh, deferred tax liability. And not arising from initial recognition of goodwill, etc., you can recognize the DTL in this regard. Okay, so this is how you are having your taxable temporary difference where there are exceptions. Where there are exceptions. Okay, all right. Yes. So these additional questions go through the sheet which I have added. Yes, you can get that. Investment in subsidiaries, branches, and associates. DTL recognized except for control over timing, non-reversal probable. Recognize DTA only when reversal in foreseeable future, taxable profit available. Okay, go through these. There is no much time left to solve the questions. Okay, assess also reassess deductible temporary difference. Deductible temporary difference means DTA. DTA. What is the impact of DTA? If you look at the entry that you pass is DTA account debit to P&L. DTA account debit to P&L. Now, what happens is this is giving rise to income and this is giving rise to an asset, which is notably known to be what you can say deferred tax in nature, which is deferred tax in nature. And therefore, considering that it is deferred tax in nature, the problem is we are booking an asset, and that is why the standard says be very cautious when you are booking a deferred tax asset because it gives rise to income and asset without a tangible source of that asset. Okay, without a tangible source of that asset. So you just recognize it based on, you can just recognize it based on what you call there should be a probable chance that taxable profits will be earned in the future for utilizing this deferred tax assets. Okay, you need to have sufficient taxable profit in the future to meet this particular deductible temporary differences. Okay, if there are insufficient taxable differences, DTA recognized to the extent that it is probable that NT will have sufficient taxable profit, or tax planning opportunities are available to the entity that will create taxable profit in appropriate periods. Okay, so you could do this. Okay, DTA, when can you recognize? Okay, all right. Next. All right, fine. Assess. Okay. So recognize previously unrecognized DTA and reduce the amount of DTA. Whatever be the situation, you will do this. Okay. All right. Determining the tax rate. Which tax rates are you going to use? Sir, you are going to use higher or lower rate. One second, not this one. Okay, sorry. This is the one. At which tax rate? At the tax rates expected to apply when the asset is realized or liability is settled. That means futuristic. That means futuristic. Okay. Or based on tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. Okay, so take the rates that are in force enacted or expected to be enacted, because these pertain to settlements in the future. So you cannot take the current tax rate directly and do the working. In some jurisdiction, the manner in which an entity recovers the carrying amount may affect either the tax rate or tax base. In such cases, entity measures DTL DTF using the tax rate and tax base that are consistent with the expected manner of recovery or settlement. Okay. All right. So these illustrations, please do try them. Okay. All right. Where do so calculating deferred tax, taxable temporary differences into tax rate gives you DTL. Deductible temporary differences into tax rate gives you DTL. No discounting of deferred tax assets and liabilities. Carrying amount of DTA to be reviewed at the end of each reporting period. Coming to accounting of deferred tax, what is outside the P&L? Tax impacts will go outside the P&L. Related tax effects to be recognized in SOCE. Okay, that is one. Transactions and events recognized in P&L. Related party effects also recognized in P&L. Okay, accounting for deferred tax. Next one is offsetting DTA and DTL. Can you offset and present a single figure? Answer is yes. Because if there is a legally enforceable right, then and the intention is to settle on net basis, you can present it off when current tax can be offset by the same tax authority. All right, next. Deferred tax arising from business combination. Okay, all right, this we can see later, maybe in the next class. Okay. Okay. Two, three special transactions are left: business combination, share-based payments. That's it. Coming to disclosures and some questions. Try to see if you can go through those questions, all the questions by yourselves. Okay. Just ensure you have the questions done. There is a very nice question in the latest edition of the RTP issued by the Institute. Please do visit that. Okay. I want you to go through these questions, whatever I have told you. You can refer the earlier videos where we have actually discussed and solved. We have a session on Friday, no, not Friday, Saturday. So on Saturday, if there are any issues relating to Ind AS 12, I can take that along with the others, because Saturday, Sunday, we have two continuous sessions. We can, cover up this also along with that. As of now, I have brushed through the major concepts and the steps. Couple of questions, we can definitely address it towards the end of the session on Saturday. Is it okay with everyone? Yes. Is it okay with everyone? Yes, because it went a bit fast, because we were slightly took Ind AS 19 in detail, because that is little more complicated than this. Okay, so with this we shall continue the session on Saturday. Yeah, any doubts? Please feel free to ask. Please feel free to approach. Yes, nothing else from my side. See you guys on Saturday. Okay, go through those videos and come. Okay. All right. Thanks. Thank you. Thank you, everyone. Yes. Thank you.